Thanks very much, John. The Fed's balance sheet out, which we're looking to closely to see how much borrowing banks are doing from the Federal Reserve. And the balance sheet did rise again by $94 billion. Not as much as last week, which went up by nearly $300 billion. So how did it happen? Well, there was there was less borrowing at the Fed's emergency discount window. That fell by $38 billion compared to last week. However, the Fed's new lending facility, which it opened to provide additional liquidity to the banking system, that totaled $53.6 billion. That was up by nearly $42 billion from the prior week. So banks are liking this program where they can take their discounted treasuries and mortgage-backed securities and get loaned at par. Something that I'm curious about, I don't quite know the reason for this, but the Fed's loans to the bridge bank that have been, for the banks that have been formed in place of the banks closed down, it rose to $179.8 billion from $142. That was another source of the rise. So the treasuries, the Fed is still doing quantitative tightening, but it's also increasing the size of its balance sheet through this additional lending that's going out there. John, it's a pretty good deal for these banks to borrow from this new fund. So I would be a little careful in thinking that that's a sign of stress in the market. It could be a sign of preemption, just prudence on the part of banks. It could be a sign of stress, but it could also be a sign of banks getting a pretty good deal at this new window where they can borrow at 1-year OIS and basically pay the Fed, or the Fed pays them interest on reserves. There's a bit of a spread in there. So just be a little careful. There is the fund is being taken down by the banks, and we're watching it closely.
Yeah, explain. This isn't contradictory. Powell was talking about this yesterday, the Fed tightening while also, in this case, expanding the balance sheet. How does that work?
Yeah, it's a little complicated to explain, a little complicated to understand, but the idea is, and I'd love to hear Alan Blinder's explanation for this. The idea is these are temporary measures that are designed to provide additional liquidity. And they create reserves upon which banks won't be out there lending against. So these are temporary reserves that are out there, that some of which will go away. For example, when the banks are sold, in receivership are sold, that loan to the FDIC, that'll go away. And when this program runs out in a year's time, these reserves will also go away. So it's a temporary thing. The Fed is continuing to sell or allow its balance sheet to run off through quantitative tightening while providing some temporary liquidity that should not be inflationary, because it should not enhance economic activity in that time. Whether or not it has a downward impact on interest rates, that's another story.